Folks, welcome back to the macro setup. That's my friend Dan Nathan at Risk Reversal. I'm Guy Adami. This macro setup is brought to you by our presenting sponsor, Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. Dan Nathan, we've seen an interesting couple days. Yesterday, we did a webinar hosted by Nadex. It was interesting. We had Travis McGhee hosted it. We had some great Q&A, I thought, back and forth with the audience. We talked about maybe traders and investors squaring up into the election. That carried over into today's action. We're going to talk about the VIX, but we've seen the VIX go from 40 down to this 35 level. Is that suggestive of a potential outcome, Dan, in tonight's election, or is that more indicative of people just squaring up ahead of what could be a very long night, if not a long couple of weeks?
Well, first things first, Guy, you are coming in hot this Tuesday morning, election day. I suspect that you were already early at the polls when they opened this morning, kind of making your voice heard. Listen, this is a big one, man. I think back to trading elections in the past. Midterms they don't really trade on unless there was like the last one, the potential for like the House or the Senate to flip. But this one, there just seems to be so much riding on it. It's really interesting. You mentioned the VIX here from 40 to 35. You've been all over that, especially as we've been speaking to the Nadex and the IG audience over the last month or so, and what that means to you. And what really you've been kind of keying on the fact is that the market, the S&P 500, which the VIX is obviously tracking the volatility of its components, has been trading in a range. We're going to pull up that S&P chart in a second here, but it's been trading in a range for 2.5, 3 months, but the VIX has remained elevated. And you said, keep your eye on that. And what's going on there? You've seen massive hedging in front of this event. I think investors are pretty hedged up in front of this week, which is one of the reasons why you could see, or why we're seeing this sort of bounce over the last couple of days, about 2.5% in the S&P 500. But there's also been a lot of options open interest data coming out suggesting that hedge funds are really kind of bulled up on the long side, thinking that no matter what happens, the market rallies from here. I'll just kind of touch on this S&P and I'll kick it right back to you. 35.88, September 2nd, that was the all-time high. September 24th, just above 3,200. We found a low 3,400, that February high. That seemed to be that kind of battleground sort of level right at the midpoint of that 2.5 month range or so. We're below that, but obviously last week we made the low right above the prior low. So we made a high above the prior high. We made a low above the prior low. It feels like tension is building in this $3,200 to $3,600 range. And if we do have a clear outcome in the next few days, it seems like we are ready to rock and roll one way or another.
Yeah, and you folks at Nadex, hopefully you've been watching the macro setups, because we've, from day one, we outlined these ranges. And so this is not revisionist history. The levels that Dan pointed out are the levels that we've been talking about in terms of opportunity to trade against. What we've said all along is this 3,400 level, which probably is where we close at today. It would be fitting that, we close today ahead of these results potentially tonight at the level that we topped out at, the previous all-time high back on February 20th. I believe, to be exact, if you really want to get down to the minutia, was 33.93 or thereabouts, but 3,400 is close enough. And that's that long horizontal line in the middle. And Dan mentioned the VIX, and we're going to bring up a VIX chart in a minute, but I just want to speak to something, because when the VIX was trading around 25, one of the things that I had been saying for weeks was, I don't think the VIX is properly pricing in the chance of a contested election. And now here we are with the VIX that spiked up to 40. And Dan and I had an interesting conversation on Fast Money last evening, where I thought a 40 VIX was suggestive of a contested election, and anything short of that or anything different, any concession speech on either side this evening would probably knock the VIX down to the low 30s or the high 20s. And I'll stand by that. So if you don't see an outcome tonight, I think the VIX has already priced that in. And if you do see a concession speech this evening by either candidate, I think the VIX comes crashing down and maybe gets back to that 25 level. So that's as what they say makes markets. In terms of the levels, Dan, you pointed them out really, really well. We're right in this range. You've been able to trade the range that we've talked about, with 3,400 being your pivot. And quite frankly, I don't think that changes in the foreseeable future. I still think we're going to bang around these levels, Dan.
Yeah, so let's just talk about potential outcomes. And there's three, right? We know that, one, that the pollings and the prediction markets are suggesting is that you're going to have a Biden victory and possibly a Senate flip to the Dems. In that case, if it's decisive and if it happens over the next day or so, then obviously that is a positive outcome. I think that's what the market is rallying on. There's also the possibility that Trump wins, and it would be an upset, and maybe the polls are wrong again to some degree. And in that case, if you didn't, if Trump won and maybe the Dems take the Senate, maybe you have a divided government, and maybe that's bullish too. Okay, so those are the two outcomes that are the most likely outcomes. And then there's that one about a contested election that goes on and on and on. It's going to be in the courts, it's going to be local, it's going to be state, it's going to be federal, ultimately to the Supreme Court, and that's one that could really drag out. And I'm telling you that I don't think the VIX here right now at 35 is pricing that in at all, because I just think that is like purgatory for risk assets without any sense of clarity. So to me, I would say that we would be in a heightened level of volatility. I suspect we would break 3,200 on the S&P 500 and the VIX. This is really important, and I want to get your take on this. The equal weight S&P 500, okay? We know that 5 stocks, Facebook, Microsoft, Apple, Google, Amazon, make up about 24% of the weight of the S&P 500. If you look at the equal weight, that's the RSP, the ticker there, you see that the equal weight never made a new high. The S&P 500 made highs in August, right? And it just made new highs seemingly every day. But the S&P equal weight didn't. It tells you that there's some groups in that index of 500 that have really held back here. What is your take on that? And what is your take on the fact that we saw some heavy selling in the FMAGA complex last week after really good earnings? Where do you kind of fall out here, Guy?
Yeah, well, that's great. I think this is a great chart because it illustrates everything you've been saying about, again, your MAGA complex, and then you just added the F to make it the FMAGA complex. You're talking about a market. People will say, oh, it's not just 5 stocks. Well, you know what? This chart tells you, quite frankly, that it's just been a handful of stocks, literally, that's been carrying the broader market. And the fact that this RSP, this weighted average, could not trade up to those February levels, I think speaks volumes. But quickly, I want to just, for you armchair technicians out there, there are a couple things I want you to look at. That March low for you, Carter Worths or Carter Worth wannabes, that is a huge island reversal on the downside, and you saw the subsequent rally. You saw a similar island reversal in June. You saw the subsequent sell-off, and I'm here to tell you, the way I look at this, you could see a push towards that 120 level, and you might be setting up for the mother of all double tops in an RSP. That's probably the most indicative thing and the most important, or one of the most important charts that you can look at. So again, I think clarity might get you that 120 level. I think clarity might wake people up to the fact that nothing's really changed. COVID seems to never have gone away. Whether we do government shutdowns or not, people's behavior will change into the winter. And I think that could mark another top potentially in a major way for the market. But that's just how I look at this chart real quickly, Dan.
Yeah, and that takes us to the Dow Jones Industrial Average, 30 stocks that are price weighted, not market cap weighted. And this is an interesting index. We know that there were some changes made to that, especially after the Apple split 7 for 1. And then we had Salesforce.com, also a high price stock at 276 or so as we speak in there. Again, the Dow never made a new high from its February highs. It found some support just yesterday or Friday, right at its 200-day moving average here. So we're at 27,200 here with a prior high just below 30,000. I know that you had your Dow 30,000 hat ready to go in late February. I don't know if you ever donned it, but what's your take on the Dow here? That range seems to be, volatile range if you think about it. 1,000 to the downside here. Did it find the support you think the Dow needs? And are the components of the Dow the sort of stocks that might act better under one of those situations we get after the election with some clarity?
Lots to unravel there. I'll say this, as I said about the RSP. I mean, you have very similar reversal.
Yeah.
Have in the RSP, and I'll be consistent here, and I will tell you that we probably make a push up to that 29.5 level or so, which was the high, I believe, on February 12th. And I do think we fail. And I think we fail in potentially a significant way. In terms of the components, if you look at the names, these industrial names have gotten off the mat for the first time in a while. You have banks rallying today. I think that rally in the banks is probably short-lived, probably people cleaning up positions into these results. But the Dow, to me, does not have the same meaning as it might have had when I started my career in the late 1940s, early 1950s. So I'm more of an S&P 500 person. I think you are as well. I understand why people look at the Dow, and I understand there are instruments that you could trade around it. But I think the S&P 500 really tells the story. And to our earlier chart, the levels that we flagged have held up extraordinarily well. I would submit we probably close right around that 33.93 level, and it's going to be a fascinating night. And by the way, we're going to have the Chief Commercial Officer of Nadex, Travis McGhee, on, and we thought it'd be important to bring him on because if you remember 4 years ago, the crazy swings, not only in equities, but in the bond market, in currencies, in commodities that evening were unbelievable. I remember being on TV, I think at 3:30 in the morning with Michelle Caruso Cabrera, and the swings we were seeing were tremendous, and it provided, for those that have the temerity, incredible trading opportunities. And Travis is going to speak to some of the products you can look at as the day progresses and in the wee hours of the night. With that said, Dan, I look at this and say we probably held support. We're probably going to test those February highs. I do think we fail if and when we get there.
All right, so you said you're more of an S&P 500 guy. I'm more of a QQQ and NASDAQ 100 guy. I mean, to me, one of the reasons why I came up with the MAGA complex, Kramer was using FANG, and I was thinking about FANG, which was Facebook, Amazon, Netflix, and Google. And two of those names were just small names. Facebook was, a few $100 billion in market cap. Netflix at the time was about 100 or so. And it was really just Amazon and Google. So to me, really, MAGA was more interesting because all those were $1 trillion market cap stocks at the time. I think we came up with that on the set, really in a commercial break during Fast Money back in September 2018. And those to me just were the real drivers. You had to throw in Microsoft and Apple. And so the QQQ has been so fascinating because in a way, you don't really even need to take the idiosyncratic risk with one of these names individually. That's why I just think that the QQQ, the NASDAQ 100, it's just a great trading vehicle if you believe that the best names in the market are going to lead us up in a good market, and then they have the potential to really snowball and lead us down to the downside. So to me, I'm a QQQ guy. We have this chart. I think our viewers are fairly familiar with it. We have that uptrend from the March lows. That recent high last month in October never got above the September 2nd all-time high. And here we are with some underperformance clearly last week in these big names as you see some selling after the results. I think some investors are saying maybe that's as good as it gets for a while. We know there's regulatory headwinds. There's going to be tax uncertainty. So there's a lot of things going on there. The QQQ or the NASDAQ 100, that range, guy, is really 11,000 to 10,700 support. But below that, there's just, an air pocket down to 10,000. What's your take on the NDX? And listen, I'm just telling you guys this. The way I think about this, it's like, yeah, you can pick individual stocks, but when you think the market is overdone and you think the underperformance in these names from the highs is that much greater than the broad market, that's where you buy the NDX, in my opinion.
It's interesting. And I think you've made a great point in terms of the vulnerability of this index vis-a-vis a potential Joe Biden victory and, potential blue wave, as they say. And this is not political. This is not any in terms of wishing or hoping. I'm just trying to read the tea leaves here. But I think what you're saying is there could be huge tax ramifications if candidate Biden were to be elected and if you saw a blue wave through the Senate. And that could really, really hurt this space. And I'm not nearly as constructive here as I may be short-term in the Dow and the S&P 500. So I look at this and say, and we've been consistent with this one, the major uptrend since March. A few weeks ago, we talked about the potential for the NASDAQ to retest that trend line in the form of probably 12,100. I didn't think it would get back to the all-time high of 12,400. And that played out almost to the penny, as they say, and we failed once we got there. We seem to have found support. I'm hard pressed to believe we're going to make another run up to that trend line. That's just my view. And I think we vacillate around here. But I think if Joe Biden were to win tonight, I think there could be tremendous pressure in this index. And you mentioned not to necessarily look at those individual names, but I think you would submit that those names, if they came under the pressure we think they can come under, it's really going to do some damage to the NASDAQ, the index itself, Dan.
Yeah, and obviously the S&P has their 24%. Let's move to the VIX. I know we talked about it. I just have one chart here. We know that that breakout in February above 20 was significant. The long-term average prior to, let's say, last year in the VIX had been about 20. We know in the age of QE and ZERP and all that sort of stuff, we were kind of flatlining in the low teens here. But that breakout was significant, and the inability, even in the August highs of the S&P 500 or into September, to break that 20 level. You have been flagging that. We're not going to go through that again. But the fact is that volatility had been coming up into the election. We know that we've now had a bounce in the market over the last couple of days, and we've seen the VIX come in. We never got to that 44 level back in June when we had that sell-off after the surprise May jobs report. Mm-hmm. So what's your take here? And then we're just going to flip to another chart right here. We know that in a decisive victory, you think we see a VIX with a high 20s sort of handle. But how can we read the tea leaves from this VIX versus the SPX 1 year? How do you think about this and the relationship, the correlations of the S&P?
Yeah, and we're going to bring Travis McGhee on in a minute to talk about the products. But what I'll tell you in terms of the VIX, and if you could just go back to that prior chart, I want to just sort of flag something and we can speak to this. So my assertion all along, as I said earlier on this show, is that a 25 VIX was in no way pricing in the potential outcome of a contested election. And I think we finally got that in the terms of this move up to 40. You mentioned that up to 44 in June, but on that June, I think 11th, if I'm not mistaken, high, I think we closed right around 40 and a half. And that's pretty much where we topped out at a few days ago. The fact that the VIX is still 35 or so is obviously concerning. I'll say again, if you see a concession speech tonight, Dan, by either person, which, I'm not suggesting I know that there will be, but what I'm saying, if there is, and if you believe that could happen, the VIX at 35 is much too expensive. I think you'll see a VIX significantly lower than that. And I think that will coincide with a subsequent rally in the S&P 500. And again, I'll say all those things I think will be short-lived because there are bigger problems than just this election, not least of which is this COVID situation, which is not going away anytime soon. So that's just that's my sort of quick take on the VIX. And quite frankly, although the VIX is not a trading instrument, I look at it as an indicator of not necessarily the next 24 hours, but the next couple days. And quite frankly, Dan, it's done a pretty good job on that metric.
Yeah, I think the main point here is trying to catch those reversals is really hard in the VIX, right? And they're going to be pretty obvious. But the fact that the VIX has remained elevated has told you that there's some trepidation about what's going on. And I think you hit on a really key point. We've known for 6, 7, 8, 9 months now that we have been in an economic crisis and a health crisis. And what a contested election does is throws us into a political crisis. And those three together would be obviously something that would really test the foundations of our country and all the institutions that we rely on and really dependent on the guardrails, which is why I will tell you that if things get really nasty, and I'm not saying they are, I actually think we're going to have an outcome this week. But if they do, then the VIX is going to be well above that June high for a bit, and we may remain elevated in the 30s. Okay, let's talk about the dollar. You had a really good call. I mean, yesterday you thought that all signs point to dollar weakness here. We had that breakout of that downtrend from the March highs here, but now we're retesting it. If we kind of go through that uptrend, which was resistance, now support, but we break it to the downside, you think we're headed for 92 in the Dixie and possibly lower lows?
Yeah, I think, as I've said before, obviously this little bounce to the upside, it went higher than I thought it would go, but we talked about the potential for a counter trend rally in the dollar, and that's what we've seen. But you go back to March, and I think you can really learn from history here that in times of volatility, the market seems to find some form of strength or some a flight to quality, and I'm putting those in air quotes, in the form of the U.S. dollar. But those moves have become shorter and shorter lived, and you see what an opportunity in March it was to get out of dollar length or actually put on a short position. And I think you're setting up for the same thing. You could see a flight to quality in the form of the US dollar if, in fact, you see some sort of contested election. And again, other people have different views. I think that's typically what happens with the market, but I do think it's short lived. And I think an outcome on either side, in my opinion, Dan, is dollar negative because I think both sides have a vested interest to push through some fiscal strategy early next year. And for the life of me, although others will argue to the contrary, that's not dollar positive because, as we've said a number of times, they're creating this money from somewhere. And unfortunately, in the case of the United States, it's out of thin air. So, I do think this sets up for maybe one more push to the upside in the flight to quality. But I think you fade all rallies in trader jargon in the US dollar.
Right. So that makes you buying dips in gold. GLD, we have a chart right there. You see this thing is in a well-defined downtrend from its August highs. You had been saying 2000 in the shiny metal. We almost got there in the summer, but why is it not acting better? It definitely has corresponded. We've had this dollar weakness during that same period of time. What's your take on gold? And will this be a flight to quality if we have an uncertain outcome?
I think to answer your first question, the reason why it hasn't performed is twofold. I think people have looked to Bitcoin for whatever reason. I'm not suggesting it's right or wrong, but I think the rise recently over the last couple of months in Bitcoin on very positive headline news for the cryptocurrency has probably created a bit of a headwind for gold. I think the other thing is the fact that the dollar has gotten off the mat recently, and I think that's provided a bit of a headwind. I think people are just taking their eye off the ball. I also believe, Dan, just to add one more component to this, that you've seen historically when the market sells off in a meaningful way, like we've seen the last couple of days notwithstanding, but what we saw last week, that typically creates some weakness in the metals for whatever reason, most of which are potential margin calls and need for people to raise funds in the form of maybe selling off gold positions. Again, that's just my view of gold over the last 3 weeks, month and a half or so. In terms of levels, as you said, you see a very well-defined downtrend here from the middle of the summer. You do see that one low. I think it was late August, early September. We seem to have traded down there and bounced. I happen to think we're going to trade through this downtrend line, and I happen to think we're going to take out the levels that we saw earlier this summer. I'm not a tinfoil-wearing gold bull, but I understand what's going on in the world. I do understand that central banks globally are tripping over themselves to devalue their currency. I do see central banks buying gold, and I think at a certain point, people are going to realize that there is safety in the precious metal, and gold is not a commodity. It's a store of value, but that's for another show, Dan.
All right. So real quickly, because we got to get Travis in here, I'm dying to talk about some of the expected or some of the overnight volatility, because we know that was a huge, huge trade back in 2016 in the wee hours of that election night. A lot of that had to do with a very surprise outcome. When you see everyone leaning one way and the polls leaning one way, that leads for surprises. I'd be shocked, though, if we are in a position where we could see this sort of surprise that we saw last time, because, listen, the guy who surprised is now the incumbent here, and he is definitely the underdog, at least in the polls. But I just think the positioning that we've already seen has been very extreme. One of the quickest moving risk assets back in 16 were U.S. interest rates. They actually rallied. The expectation was that we were going to have, just tons of growth here, and people kind of moved into that. That reversed pretty quickly, though, when it became clear that there was going to be a lot of deficit spending, lower tax receipts, all that sort of thing in 2017. But you have the 10-year Treasury yield breaking above its 200-day moving average, which, I thought it got rejected last week there, but it held support in the near term, and it's breaking above. What's your take on rates here? And can rates go meaningfully higher in this environment, no matter who wins? Because the Fed's already told us that the economic fallout from this pandemic is going to take a very long time to heal, meaning rates are going to remain low. They're going to remain accommodative. How can rates get in front of that?
It's interesting. There's so much we could do an hour-long show on just rates and why they move, and if they're moving for the right reasons or the wrong reasons. What I'll tell you is I understand why there'd be a school of thought that suggests that the economy is improving, which is why we're seeing interest rates move to the upside. And quite frankly, you saw some ISM numbers out yesterday that were encouraging. I get it. What I'll tell you is just my opinion. I think rates are going up for the wrong reasons. I don't think the Fed has any control whatsoever. They have control over the front end of the curve. They don't have it on the back end, despite what they might say. And if you see rates and I've been pretty consistent, close above 90 basis points in the 10-year, or for you folks that will chart the TLT, I know that's not an instrument on Nadex, but just quickly at 155 level, if you want to sort of have it up, has been a huge level of support. That coincides with the 90 basis points or so. I get really concerned because you could see a scenario where interest rates go up, the US dollar goes down, and I think that's a really unhealthy brew. So if you're looking for a line in the sand, to me, Dan, it comes in the form of 90 basis points. I think interest rates are going up for the wrong reasons because I do think there is inflation all around. It's just that the Fed doesn't measure it, and I'm not trying to do some Fed bashing here. It's just my opinion. But I think, again, a close above 90 basis points, and you have to have your antenna up, especially if you see a commensurate sell-off or a subsequent sell-off, I should say, in the US dollar. And with that, Dan, I think it's a good time to bring in the chief commercial officer at Nadex, a friend of mine for over a decade, a United States Marine, a badass, and I'm going to use that term because he is, and I am allowed to say that, my friend Travis McGhee. And I know Dan has some questions for you, Travis, but 4 years ago, you saw the volatility, you saw so many different things trading in ranges that we never saw it possible. Can you speak to what I don't want to say what you're looking for, but what you've prepared for this evening?
Yeah. No, hey, thanks guys for having me on. Yeah, I mean, absolutely. That's the beautiful thing about Nadex, right? It's having access to those short-term moves in the market. As an exchange that's open 23 hours a day, 5 days a week, we provide traders with a unique opportunity that's hard to find in other places outside of the futures market, especially for some of those equity traders that are used to trading ETFs. And you lose that ability to trade those moves happening after hours in a big way. And you to your point, Guy, you think back to some recent events, and I mean, I can name two just off the top of my head. One being Brexit, right? And the announcement that came out overnight and the volatility that resulted, and the 2016 election. Your conversation earlier about the VIX, which I think is spot on. Regardless of the 1,000 points or so we've added to the Dow over the past couple of days, we've still got a VIX sitting around 36, which is pricing in over a 2% daily move in the S&P. And you look at a day like today, it's close to a 2% move. But I think what's interesting and where Nadex comes into play, certainly on an election night, when you have so much news rolling out over the course of a 5-minute period, a 10-minute period, every half hour, is the velocity of those moves. And it could be 1% down in a matter of minutes, and the next thing you know, we reverse 3%. And that's where Nadex and our products come into play, is you can capitalize on those short-term moves in a risk-defined way without all the margin requirements and complexities that are involved, and contracts that are structured anywhere from 5 minutes in length to a day or a week in length. So you can really pick what's most suitable for you based upon the time frame you're looking at.
Travis, it's, I come from a little bit of the options world. And when you're kind of expressing a view with long premium, that you've defined your risk for all intents and purposes. And sometimes I just think that's a really important way to think about trading events in particular, right? Rather than just kind of having a view and letting it play over time, but on a short-term basis, when you're trying to maybe be contrarian or catch a wave or something like that, or catch like the news flow, defining your risk is just a really important point. So, I mean, is that something you guys spend a lot of time on, focusing on? Okay, when you're looking at charts and you're trying to express a view, where would you put your stop in? And these are the sort of products that can help you do that.
Yeah, no, absolutely. And we have a number of products that are structured just for that. So you look at, our product, the Knockout, which is, operates very much like a future and is structured very much so, but it's got that built-in bottom downside protection and a built-in exit on the top. So if the market drops and hits that downside barrier, it takes you out of the trade. And then on the flip side, if it rallies up and hits that upside barrier, it takes you out of the trade. And listen, that's a great product, especially for days like today. If you're not glued in to your trading platform, the Nadex platform, every single minute. It's nice having a product like that where you have that disciplined approach. And you guys can speak to this as well as anyone, all of us as former traders. Discipline's everything. And it's understanding what that downside exit is and being able to pull the trigger when it hits it. And as Guy always says, not getting too emotionally attached to your trades and being dogmatic in your views. And then the same to the upside. When it hits that upside, being able to pull the trigger and exit that trade. So that's, at Nadex, that's something we're big on. Obviously, it's that disciplined approach. But you look at the structure of the products and what we have, and again, you go back to that risk defined approach. Our products are fully collateralized, so there's no margin trading at Nadex. What you put up is what you stand to lose. That's it, nothing more. And they're great. They're still a derivative. So you still have some of the benefits of effective leverage and some of that comes with trading options without all the complexity. So for those equity traders out there that are on the fence and would like to kind of dip their toes in the waters of trading a derivative or option-like product, it's great because you can do so with that defined risk, and you can do it 23 hours a day.
Travis, what should people have up on their screens in terms of the products that Nadex provides as we look at not only the next couple hours, but the next 24 to 48 hours?
Yeah, definitely. So, I mean, obviously the S&P, everybody, it's one of our top products, especially in markets like these. All eyes are on the S&P and the price action. You look over, certainly the past couple months, and it's been the NASDAQ. And certainly the NASDAQ is going to be of some interest as well, as you guys had spoken about earlier. One of the unique product sets too that Nadex offers that's difficult to find at some of your retail-oriented brokerage firms, especially the larger ones, is FX. So we do have that access, almost in similar to a spot FX type of way. We provide access to some of those major currency pairs that people are trading, whether that's euro dollar, pound dollar, something this morning, Aussie dollar of particular interest, and it's one of our top traded products right now as of 10:30 Eastern time due to the rate cut last night. So by the RBA. So certainly euro dollar, pound dollar, Aussie dollar, those are of particular interest as well.
Well, Travis, I want to thank you I know how busy you are today, so I appreciate you spending time. It's going to be a long, probably couple days for you and your team, so I'll let you get back to it. But again, that's Travis McGhee, the Chief Commercial Officer at Nadex. That is Dan Nathan at Risk Reversal. Dan, you want to sort of close us out? Any closing thoughts? I know you're passionate about this stuff.
No, I am passionate about it. I think a lot of what Travis just kind of keyed on, I think defined risk, in fast markets like this is really important, or really using stops here. No one knows what the outcomes are going to be, and no one knows how market's going to react. I don't love the fact, I know that last week was a really bad week, the worst week in equity indices since March. I don't love the fact that, if we kind of squeeze and close towards the highs of the day today, I don't love a 5% 2-day rally into an event that we don't know the outcome with. So, I just say be careful in that regard, because the likelihood of a follow through, given what could happen, is not particularly great. And we know that there is a potential for volatility going the other way when everyone's kind of leaning on one direction.
He's at Risk Reversal. I'm at Guy Adami. Travis McGhee, I believe, is at Travis McGhee. I'm sure we can find him on the Twitter. I want to thank our presenting sponsor, Nadex, the premier U.S. exchange for trading binary options, knockouts, and call spreads. This has been the macro setup. Good luck today, folks. It's going to be a fascinating 24 hours, if not longer. Good luck, Dan. Thank you. And Travis, thank you.
Thank you.
On the other side.